I need to talk to you about something that's happening in the silver market right now, and it completely contradicts everything the bulls have been saying. One of the most respected commodity strategists on Wall Street just went massively short on silver at $78 per ounce. His target? $40. That's a 48% crash from his entry point. But here's what makes this absolutely fascinating. He's not just some random trader making a lucky guess. This is Daniel Ghaly from TD Securities. The same analyst who predicted the silver squeeze back when silver was at $44. The same guy who warned about London vault depletion. And now, he's betting millions that silver is about to get destroyed. Before we dive deep into this trade, smash that subscribe button and turn on notifications. You're going to want to follow this story closely because what happens in the next 2 weeks could determine if you make or lose a fortune in silver. Let's break down exactly what's happening, why it's happening, and most importantly, whether Daniel Ghaly is right. First, let me give you the exact trade parameters so you understand what we're dealing with here. Daniel Ghaly entered a short position on silver futures at $78 per ounce. That was his entry point. This happened just days ago, on January 7th, 2026. His target price, $40 per ounce. Now, let me explain what this means in plain English. If silver drops from $78 to $40, that's a decline of $38 per ounce. That represents a 48% crash. For everyone who bought silver at these elevated levels, thinking it's going to $100, $200, even $300 per ounce, this trade is saying you're about to get absolutely crushed. But here's the critical detail that separates professionals from amateurs. Ghaly set a stop loss at $92 per ounce. This is crucial. A stop loss means if silver moves against his position and hits $92, he automatically exits the trade. He takes his loss and moves on. Why is this important? Because it tells us two things. One, he's not infinitely confident. He knows he could be wrong. He's risking $14 per ounce to make $38 per ounce. That's a risk-reward ratio of roughly 1 to 2.7. In trading terms, that's actually quite reasonable. Two, the level at $92 is significant. If silver breaks above that level, it invalidates his entire thesis. It means something fundamentally changed in the market that he didn't anticipate. So we have a clear trade. Short at 78, target 40, stop at 92. Now the question becomes, why is he making this trade? What does he see that the silver bulls are missing? To understand Ghaly's trade, you need to understand something called index rebalancing. And I'm going to explain this in a way that makes perfect sense, even if you've never heard this term before. Imagine you have a basket of fruits, apples, oranges, bananas, grapes. You want your basket to always have a specific mix. Let's say you want 20% apples, 30% oranges, 30% bananas, and 20% grapes. But over the course of a year, apple prices triple while banana prices stay flat. Suddenly, apples now make up 60% of your basket's value, even though you wanted only 20%. What do? You sell apples. You have to sell apples to get back to your 20% target. This is exactly what's happening in commodity markets right now with silver and gold. The Bloomberg Commodity Index is one of the largest commodity indices in the world. It tracks a basket of commodities: oil, natural gas, copper, gold, silver, wheat, corn. The list goes on. This index has rules. No single commodity can exceed 15% of the total index weight. This rule exists to maintain diversification. Here's the problem. Gold and silver had massive rallies in 2025. Gold went from around $2,000 per ounce to over $4,400. That's more than 120% gain. Silver went from around $30 to $84 at its peak. That's 180% gain. Because of these huge rallies, gold and silver's weights in the Bloomberg Commodity Index exploded. Gold hit its 15% cap. Silver's weight jumped from around 4% to over 9%. But here's where it gets interesting. The index has a target weighting for 2026, and that target weighting for silver is just under 4%. Not 9%, 4%. That means index tracking funds need to sell silver. A lot of silver. How much? According to multiple analysts, including reports from Citigroup and JP Morgan, we're looking at approximately $6 to $7 billion worth of silver futures that need to be sold. $6 to $7 billion. And this selling isn't based on fundamentals. It's not because China stopped buying silver. It's not because industrial demand collapsed. It's purely mechanical. It's forced selling. The index rebalancing happens over a 5-day window, January 9th through January 15th, 2026. That's this week. This is happening right now as you watch this video. Daniel Ghaly from TD Securities estimated that approximately 13% of the total open interest in COMEX silver futures will be sold over the next 2 weeks. 13% of the entire market getting sold in 2 weeks. Think about what that does to prices. Now, here's where the story goes from interesting to potentially catastrophic for silver bulls. Silver has a liquidity problem. What do I mean by liquidity? Liquidity refers to how easy it is to buy or sell an asset without moving the price dramatically. Let me give you an example. If you want to sell 100 shares of Apple stock, you can do that instantly. The price barely moves. Why? Because Apple trades billions of dollars in volume every single day. There are always buyers ready to purchase. But silver futures? Different story. Silver trades much lower volume compared to its open interest. This means when large sellers come into the market, there aren't always enough buyers to absorb that selling without prices dropping significantly. Daniel Gali has been warning about this for months. Back when silver was in the mid-40s, he was already talking about how London Vault inventories were critically low and how the market was setting up for a squeeze. But now, the dynamic has completely flipped. The silver market ran up to $84 per ounce. That rally attracted a huge amount of speculative long positions. Everyone and their grandmother thought silver was going to $100, $200, maybe even higher. But those speculative longs are now facing a liquidation event. When index funds sell $6 to $7 billion worth of silver futures into a market that already has elevated long positions and limited liquidity, prices don't just decline. They can crash violently. This is what Gali is betting on. He's not saying silver is worthless. He's not saying the long-term bull case is dead. He's making a tactical trade based on a specific catalyst, forced index selling in an illiquid market. And here's the kicker. This isn't just theory. We're already seeing it play out. On January 7th, silver dropped approximately 4% in a single day. On January 8th, it dropped another 5.5%. In just 2 sessions, silver went from around $80 to $74. That's a $6 decline, or 7.5%, in 48 hours. And remember, the official index rebalancing window hasn't even fully started yet. Some of this selling is front-running. Smart traders are selling before the official rebalancing because they know what's coming. Now, I need to present the other side of this trade, because if I only give you one perspective, I'm not doing my job as an analyst. There are very smart people who think Daniel Gali is completely wrong, and they have compelling arguments. Let me walk you through the bull case. Argument number 1. Index rebalancing is temporary. Fundamentals are forever. Bulls argue that yes, there will be mechanical selling pressure over the next 2 weeks, but that selling is temporary and non-fundamental. It doesn't change the fact that industrial demand for silver is growing. It doesn't change the fact that solar panel production requires massive amounts of silver. It doesn't change the fact that electric vehicles use significantly more silver than traditional cars. Once the rebalancing is over, those fundamental drivers will reassert themselves and push prices higher. Bank of America released a report just days ago suggesting silver could reach between $135 and $309 per ounce this year. $309. That's nearly 4 times the current price. Argument number 2. The short squeeze narrative isn't dead. Some analysts, including Ole Hansen from Saxo Bank, argue that any weakness in silver should be viewed as a buying opportunity. They point out that while there may be short-term volatility from index flows, the underlying supply-demand dynamics heavily favor higher prices. They're not wrong about supply constraints. Global mine production of silver is only around 800 million ounces per year. Industrial demand alone consumes most of that. Investment demand on top of industrial demand creates a structural deficit. Argument number 3. Central bank policies still favor precious metals. Look at the macro environment. The Federal Reserve is expected to cut interest rates later this year. The US dollar could weaken as a result. Inflation remains a concern globally. Geopolitical tensions are elevated with situations in Venezuela, ongoing tensions between China and Japan, and broader economic uncertainty. Historically, these conditions have been bullish for precious metals. Silver, with its dual nature as both an industrial metal and a monetary metal, could benefit even more than gold. Argument number 4. Physical markets remain extremely tight. While paper silver futures might see forced selling, the physical silver market is a different story. Premiums on physical coins and bars remain elevated. Dealers are still struggling to source inventory. The LBMA vaults in London, which Gali himself warned about months ago, are still showing stressed inventory levels. If there's a disconnect between paper prices and physical prices, you could see a situation where futures crash, but physical silver remains expensive. That would create an arbitrage opportunity that eventually pulls futures prices back up. These are legitimate arguments. The bulls aren't crazy. They're looking at the same market through a different lens. So who's right? Let me show you what the charts are telling us, because price action often reveals truth before fundamentals do. Silver peaked at $84 per ounce in late December 2025. That was the all-time high. From there, it's been in a downtrend. The first support level that broke was $80. When silver fell through 80, it triggered stop losses from traders who bought near the highs. This accelerated the decline. The next support level is around $72 to $73. This is where silver is trading right now as I record this video. If this level breaks, the next major support doesn't come in until the mid-60s. Now, Daniel Golly's target of $40 seems extreme at first glance. That's nearly 50% below current levels. But let's look at where $40 sits on the chart. $40 was a key resistance level back in 2021 during the Wall Street Bets silver squeeze attempt. It's also roughly where silver was trading before this entire rally began in late 2024. From a technical perspective, a return to $40 would represent a full retracement of the recent blow-off top. It would reset all the speculative excess that built up during the rally. Is it likely? That's the billion-dollar question. Here's what I'll say. If silver breaks below $70, momentum shifts decisively bearish. At that point, a move to the low 60s becomes probable. And once you're in the 60s, 40 doesn't seem as crazy. But there's another scenario we need to consider. What if silver holds $72 to $73? What if buyers step in here? If that happens, and silver bounces back above $80, Daniel Golly's stop loss at 92 comes into play. A break above 92 would likely trigger a short squeeze, pushing silver potentially back toward that all-time high of 84, or even higher. This is why trading is difficult. Both outcomes are possible. The market is at an inflection point. The volume and price action over the next 5 trading days during the official index rebalancing window will tell us everything we need to know. High volume selling into support at $72 with support holding? Bullish. That means buyers are absorbing the forced selling. High volume selling that breaks through 72 with ease? Bearish. That means there aren't enough buyers and we're heading lower. There's one more factor we need to discuss, and it's something that could completely change this entire equation: US tariffs on silver. Daniel Golly mentioned in his analysis that he believes the United States will not impose tariffs on silver imports. Why does this matter? The US doesn't produce much silver domestically. Most silver comes from Mexico, Peru, Chile, and Canada. If the US were to impose tariffs on silver imports, it would restrict supply coming into the country. Restricted supply with constant demand means higher prices. But Golly's thesis assumes no tariffs. If he's wrong about that, if President Trump decides to include silver in a broader tariff package, then the entire short trade gets invalidated instantly. This is a political risk that's hard to quantify. But it's real. We've seen how quickly trade policies can change. We've seen how tariffs can disrupt markets. If silver gets caught up in a broader trade war escalation, the fundamental supply-demand equation shifts dramatically. Bulls are hoping for exactly this kind of scenario. A supply shock from tariffs combined with strong industrial demand could send silver screaming higher, regardless of index rebalancing. This is the wild card. And it's one reason why Golly set his stop loss at $92. If tariffs get announced and silver spikes, he wants to exit before the losses become catastrophic. So let's bring this all together and talk about what you should actually do with this information. If you're currently long silver, meaning you own silver or silver miners, you need to be extremely careful over the next 2 weeks. The data clearly shows that $6 to $7 billion in forced selling is coming. That's not opinion. That's not speculation. That's a documented fact based on index rebalancing mechanics. Does that mean you should panic, sell everything? Not necessarily. It depends on your time frame and your conviction. If you're a long-term investor who believes in the fundamental bull case for silver, a short-term dip might not concern you. In fact, it might be an opportunity to add to positions at lower prices. But if you bought silver recently at $75 or $80, hoping for a quick move to $100, you need to understand that you might be underwater for a while. The index rebalancing is going to create headwinds for the next 2 weeks minimum. If you're considering shorting silver like Daniel Golly, understand the risks. Yes, there's forced selling pressure. Yes, the technical setup looks bearish, but you're fighting against a longer-term bull trend and strong fundamental drivers. The risk reward might be attractive, but the risk is real. A better approach for most retail traders might be to simply wait, let the rebalancing play out, see where silver finds support, then make a decision. If silver holds $70 and bounces, that's your signal that buyers are strong and the bull market is intact. You can enter or add to long positions with more confidence. If silver breaks below 70 and heads toward the 60s or lower, that validates the bearish thesis. You can either stay away or, if you're aggressive, look for short opportunities. The worst thing you can do right now is make emotional decisions based on fear or greed. The market is giving us clear levels to watch. Use them. $72, current support. Hold here and bulls survive to fight another day. $70, major support. Break here and momentum shifts decisively bearish. $92, Daniel Golly's stop loss. Break above here and the short thesis is invalidated. These 3 levels will define the next major move in silver. I want to zoom out for a moment and give you some perspective because it's easy to get lost in the day-to-day price action. Silver has been one of the most volatile assets on the planet for decades. It's not unusual for silver to see 20, 30, even 50% moves in a matter of months. In 2011, silver ran from $18 to nearly $49 and crashed back to $26. That was a 47% decline in just a few weeks. In 2020, silver went from $12 to $30, then pulled back to $22. The point is, volatility is normal in silver. Well, what we're seeing right now, a potential move from 80 to 40, would be consistent with silver's historical behavior after parabolic rallies. Does that mean it will happen? No, but it means it can happen. And if you're investing in silver, you need to be mentally prepared for that possibility. Daniel Gali isn't some crazy bear trying to crash the market. He's a professional trader identifying a specific setup, forced selling in an illiquid market after a parabolic move. That's a textbook short setup. But the bulls also have a point. Silver's long-term fundamentals are strong, supply constraints are real, industrial demand is growing, central bank policies remain accommodative. Both sides can be right at different time frames. Short-term, bearish pressure from index rebalancing could push prices significantly lower. Long-term, bullish fundamentals could drive silver to new all-time highs. The question isn't who's right, the question is, what's your time frame? What's your risk tolerance? What's your strategy? Here's what I'm watching over the next 2 weeks. Volume during the rebalancing window. High volume at support levels means buyers are stepping in. Low volume means buyers are scared. Price action at $72. Do we hold or break? Any news on tariffs? This could be the wild card that changes everything. And of course, whether Daniel Gali's stop at 92 gets triggered. This is one of the most fascinating trade setups I've seen in years. A top strategist betting against one of the hottest markets. Forced selling hitting an illiquid market. Bulls and bears both making compelling arguments. Someone is going to make a fortune. Someone is going to lose a fortune. If you want to follow this story as it develops, make sure you're subscribed to this channel. Hit that notification bell. I'll be updating you as major developments happen. Drop a comment below. Are you team bull or team bear on silver? Do you think Daniel Gali nails this short, or does he get stopped out at 92? I'll see you in the next video. Stay sharp, stay informed. And remember, in markets like these, the most important trade you can make is the one you don't make when you're unsure. Thanks for watching.